Most of the key macroeconomic variables continue to remain stable. If you look at inflation, they seem to be under the RBI's target rate of 4%, and consequently we also see interest rate continue to remain stable to moderate levels. While economy can do with some more cut in the interest rates, we do think that inflation will be a variable which will be a key determinant of RBI's further move on the interest rates. Most importantly, we continue to see banks and non-banking financial companies continue to cut rates for their borrowers, whether it is a corporate borrower or retail borrowers. We see a drop in interest rates. This is coming after a lag from the RBI's action of cutting repo rates. So the benefits of the falling interest rates is continuing to accrue in the economy. We see that as a reasonably good tailwind in the coming days. On other macroeconomic parameters like growth, there has been some slowdown on the back of demonetization and GST. We see most of these slowdowns to be of temporary in nature. The transient impact of the change in taxation structure will go off over the next couple of quarters, and we strongly believe that the economy will get back to 6.5 to 6.75% or even higher growth rate in a year's time. So we are not unduly concerned therefore about the temporary slowdown that we are witnessing at this point of time. On the current account deficit and consequently on the exchange rates, there has been mild deterioration of the current account deficits over the last 3 to 6 months. We expect it to remain mild. We don't see a sharpening of this deficit further, and therefore we think exchange rates will also remain reasonably stable over the next 3 months or so. Markets earnings recovery is premised on broadly two issues. One is some of the sectors which have had challenging earnings in the past few years are expected to turn around. These sectors can be financials and commodities. In financials, especially banks, we have seen sharp deterioration in earnings over the past couple of years, broadly on the back of bad loans and the provisions towards those bad loans. We think bulk of the problem is behind us, and eventually I think banks' earnings will year on year will start to look much better. And the commodities, we see bounce back in commodity prices, both on energy related commodities as well as metals. So many companies in that sector also will report better than earlier numbers. These two sectors therefore will contribute to good earnings growth. Some of the earlier sectors which are delivering good earnings growth will continue to deliver decent earnings growth. These include automobiles, private banks, information technology, some bit of consumer finance companies maybe, and then utilities, etc. One more area where I think we would see recovery of earnings, not in the current year, probably the year after, is on healthcare. Again, healthcare companies had a tough fiscal 17 and fiscal 18 also would be reasonably tough, and we see some of these companies turning around in the current year. So if you look at combination of all these things, next couple of years promise to be better earnings trajectory than what the previous 2 years. Second issue on earnings growth is on the aggregate capacities. Most of the corporate India across sectors is sitting on excess capacity, and we see as demand coming back or growing reasonably stably, better capacity utilization will lead to operating leverage and improving margins for most companies. Just to put it in simple words, for generating more sales and more profits, many of these companies need not have to invest in additional capacity over the next couple of years, and this will lead to better profitability as well. So to some extent, market is factoring in some of these expectations, but as and when these expectations are met, market would market's expectations will get confirmed, and it will gain strength from that earnings recovery. So this is why we think that the markets are reasonably strong. Any disappointment happening on this front would be a bit of a challenge. We see the probability of the disappointment to be low at this point of time. Systematic investment plan has gained momentum after many years of efforts by mutual funds, their distribution partners on their clients. SIPs tend to fix a few problems simultaneously. One is it inculcates the culture of investing regularly. Second is it helps the investors to ride the volatility of the market with equanimity, which means if the equity markets are volatile, the SIP-based investments tend to be much less volatile, and therefore take the fear out of investing in equity markets. And therefore, we are not, after achieving this success, we still think these are early days of SIPs gaining momentum. The country can invest a lot more on equities through SIPs in the coming years, and therefore it will not be right on our part to say that the SIP book has become very strong and pose a problem. Another way to look at the SIP flows is that bulk of these flows are happening in the mainstream funds, or what I call as large cap or multi-cap funds, and 70 to 80% of these funds are investing in large caps. So we don't see a big problem of deploying the money that comes through SIPs into some of the core equity allocation funds of investors. Bulk inflows into niche products is what would create challenges in the marketplace, whereas steady inflows into core products doesn't pose such a challenge to the portfolio managers. There are broadly two reasons why domestic flows are much higher than the foreign flows over the last couple of years. One is that the financial investments as a percentage of savings have hit an all-time low 2 years back. And I think if the average investments in, let's say, financial savings is, let's say, 50% of the total savings, and within that, equity market savings is, let's say, 11-12%. We have hit less than 6% of their financial savings in equities 2 years back. From there, we are yet to come to the average, but investors are going through some kind of a reallocation of their savings from other forms of savings to financial assets, which will take a couple of more years for it to normalize. And after that, we think it will become a steady state flow from a retail investor's perspective. So we think some of the current flows is a little bit of a one-time rebalancing. Some bit of it is structural savings into equities. It will continue for some more time is our best estimate. The second reason why domestic flows are strong is that some of the institutional investors are coming back from the domestic market, coming into equities. This can be the pension funds, provident funds, etc. Government's regulations are enabling these institutions to invest up to 15% of additional flows into equities, and many of them are doing so because other avenues of investment returns have become less attractive versus equities. So we continue to see momentum of flows from both the retail as well as institutional investors from a domestic perspective. Even after these flows, domestic investors as a pool of investors own less of Indian equities than foreign investors. Foreign institutional investors own close to $350 billion of Indian equities, whereas domestic investors probably own about $150 to $175 billion, maybe a little less as well. So we think that it will be a while before domestic investors catch up with foreign institutional investors in terms of ownership of domestic equities. Many investors are a little bit concerned at this point of time since the markets have rallied. While there may be some pockets of overvaluation, it can be in some mid-cap stocks, it can be in some small-cap stocks, it can be in one or two sectors, market as a whole continue to remain reasonably valued, both on metrics like forward price to earnings, price to book, etc. So as an aggregate, at an aggregate level, I don't see a big risk at the marketplace, barring few areas of overvaluation. So our key message to the investors would be to continue to remain focused on their asset allocation and not to deviate from that because of either near-term returns or what may look like a lot of macroeconomic noise. We think that the economy is firmly on a recovery path. The growth India will continue to grow at a reasonably good pace amongst Asian countries as well as other emerging markets. From a bottom-up perspective, we are able to find ideas still. There are a lot of attractive ideas both from a medium to long-term perspective, most of them on the consumption side. Maybe a year or two later, we will be able to find more on the investment side as well. So from a bottom-up places, we are not seeing a drying up of ideas. So we are not therefore advising caution. We say that investors should remain on their course and not deviate much from that long-term goal.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.